I welcome you all to FCL Accountants Tuition Center YouTube channel. Luando Franklin is my name, a tutor with great and massive experience in lecturing and training accountants in Zambia, as well as a lead tutor and chief executive officer at FCL. In today's video, we are looking at the weighted average cost of capital. The weighted average cost of capital, and this topic is relevant to the students doing financial management under ACCA and students doing financial management under CA 2.5, ZICA, and other students who have such components in, or rather doing degree in accountants. So we have the topic WACC. So in this video, I'm going to define the term WACC. I'm also going to explain where do we use WACC. I'll also explain the calculation of cost of capital for different types of capital. I'll also explain how finally WACC is calculated. So we have one there, the definition. WACC is the weighted average cost of capital, which is the average return on the business venture or on the investment which the investors are expecting. And it is calculated where a project, or rather a business venture, is financed by different sources of capital. And it will be used as a discount factor or a discount rate to evaluate the projects that are financed by different sources of capital. Now, where you have different types of capital, you need to calculate the cost of such capital. So we'll start with cost of equity. Cost of equity is denoted by KE. So the cost of equity can be calculated using two methods, depending on the information available in the question. We have one CAPM. CAPM simply means capital asset pricing model. So the ordinary share capital, which we call equity, is a capital asset, hence capital asset. The method that is used to calculate the cost of equity is referred to as pricing model. So when you are using this, we have KE is equal to interest from risk-free investment plus beta factor of a geared company, then a return from the market as a whole, less risk-free interest. Now, that's what we use. I'm not going into detail here because today, the valuation model which is here is the dividend. We have dividend valuation model or dividend growth model that can be used to determine the cost of equity. So we have two situations where there is annual dividend growth. When dividend is paid, it keeps on increasing. But where dividend is paid at a constant amount, there is no growth. So where there is a growth, the cost of equity will be DO 1 plus G divided by PO. The DO is the dividend paid now. G is annual dividend growth. PO is the share price, which is supposed to be excluding dividends. So when the examiner quotes the share price as cum dividend, it means the dividend is included and therefore it should be removed. Now, where there is no growth, it will be cost of equity will be DO divided by share price multiplied by 100. So there is no growth. Dividend has been paid at the same amount throughout the period or years. Number two, we have, or rather number three, we have the cost of debt. Cost of debt is denoted by KD. Is denoted by KD. Now, the cost of debt depends on the type of the debt. Today, in this question, we are looking at irredeemable debt. Irredeemable debt is debt which will exist in perpetuity. So, the cost of irredeemable debt is interest 1 minus T, which is tax component, over market price of debt per par, and it should be excluding interest. If it is quoted cum interest, ensure that you remove the interest. If it is quoted excluding interest, do not adjust. So for today, we'll just look at the irredeemable debt. After this, you need to work out the market values of the securities. The market values of the securities and the proportions. In number 5, we can now calculate WACC. WACC is denoted by KO, and it is calculated as KE, which is the cost of equity, multiplied by the proportion, which I'm going to show you how to calculate the proportion, plus the KD, 1 minus T, the tax component, plus multiplied by the proportion. So basically, these are very important steps that you need to take when calculating the WACC. So now we can go to the question. We have the question here, L Limited. The balance sheet as at 31st December 20X5, net assets, capital, and reserves. Reserves, now take note, the reserves have no cost of capital. 10% irredeemable debenture, that's what we are looking at. The current market share price is 1.32 cum dividend, which means it includes dividend. And a dividend of 12 cents has been paid for many years, so it's constant, there's no growth. The debentures are trading at 90, excluding, so you don't need to adjust, excluding interest. The corporation tax rate is 30%. Calculate the weighted average cost of capital at 31st December 20x5. So the first thing that you need to do is to adjust the share price. So share price we are given. Share price in this question is 1.32 less dividends paid. The dividends there, we are told it is 0.12. So we have share price excluding dividends, it is 1.20. So now we can calculate the cost of equity. Cost of equity will be dividend paid, 0.12 divided by the share price excluding dividends multiplied by 100%. So here we have the 10. So the cost of equity is 10%. Now we go to, this is 1. Now we go to 3. The cost of debt will be interest. How much will be the interest there? Interest is always at par. So it will be 10% of 100, because debts at par is 100. 10% of that, it will give us 10. $10. Then we have 1 minus the tax component, which is 0.3. Divide by 90. Multiply by 100%. So this will give us 7.8%. So we have calculated the cost of equity and the cost of debt. So number 4 will be market values and proportion. The market values should be market value of equity, abbreviation. So you need to know how many shares are there. The value of the shares is 15 million. 1 share is 50 cents, so you divide. So it will be 15 divided by 0.5. We have 30 multiplied by the market share, which is 1.2. And this gives us how much? This gives us 36 when you multiply. And now we have the market value of debt. Market value of debt. The debt there is 10. And for every 100, the market value is 90, which gives us 9. Total market value 45. The proportion now, 36% of that will be 80. That's the proportion. 9 upon 45, that is 20. So the total there, it becomes 1. Are we together there? So now we need to calculate the WACC. We have the information here. So the WACC will be, let me just find the space here. The WACC will be just there. The WACC by the formula, the WACC is denoted by KO. KO, that is WACC, is equal to KE multiplied by proportion plus KD 1 minus T multiplied by the proportion. So here, the cost of equity was 10%. Multiplied by the proportion was 0.8. Plus KD was 7.8. So we ignore the 1 minus T because it has already been taken into account when calculating this figure. So it will be multiplied by 0.2. And in this case, we have here 6.24. 6.24 plus 1.56. So the WACC will be 7.8. The 7.8 is the discount factor that will be used to evaluate the project that has been financed by different sources of capital. So for today, we can end here. I would like to thank all our subscribers who have been supporting us so far. And for the new subscribers, please ensure that you hit the notification button so that you are able to receive the latest videos. Thank you, and God bless you.